This is Barry Knapp with Ironside's Macroeconomics. It's 5:42 Chicago time on Monday, October 20th. I apologize for this being so delayed this week. I was in Alabama over the weekend, and now I'm in Chicago. I just spoke at the Institutional Investor Fixed Income Summit. Our note this week was titled, Wait Till Next Year. And it was really about the current growth environment and what we think is likely to unfold, at least at the beginning of 2026. We're not quite ready to write our 2026 outlook note, but we did want to offer some sense for how we think things will develop through the balance of next year. The bottom line here is that the mix of growth is better, marginally better for equity investors this year, and significantly better for fixed income investors this year. And the idea is in 2024, governments in the fiscal year ended September of 2024, government spending increased at an 11% annualized rate. That's a little bit of stealing growth from the future, kind of a mix. This year, we just recently got the numbers from the CBO and from the Treasury Department. Government spending increased at a 3% annualized rate. So pretty good news for the longer haul, but it did put a drag on consumer spending in particular. We also had a big reversal in the immigration surge that we'd had during the Biden administration, and we have significantly higher tariffs, which are also a drag on growth. But investment is starting to pick up. So the mix of stronger investment with weaker government spending and weaker consumption is generally favorable for equities, though not all equities, right? Our theme throughout the course of the year is to be underweight the consumer-facing sectors and overweight the investment-sensitive sectors. But certainly much better news for the bond market. And this was one of our key messages we've been trying to deliver for months now, which is when the Fed started cutting rates, it was not going to cause a surge in the back end. That's not what happened last year. Last year was about government spending and the risks of government spending going up a lot under either a Harris or suspicions that Trump might spend more. Ultimately, that didn't prove to be the case. And that's why the Treasury market sold off last year. This year, the Treasury market's rallying. We're at 4%, which was our objective. We remain cyclical bond bulls and secular bond bears. So we then moved on to talk about who has the upper hand in trade policy. We talked a little bit about China having diverted exports to Europe, that being a little bit of a fool's errand. We don't think the Europeans will allow that for all that long a period of time. We talked a little bit about how we thought the IEPA decision at the Supreme Court would unfold. Become a full subscriber and you can get into all our analysis. We did make that call that the Court of International Trade was going to likely rule that was unlawful. We then moved on to a really in-depth discussion on the balance sheet. Chair Powell effectively announced the end of QT is coming. We went through the three channels of the Fed's balance sheet, not just the liquidity channel that the Fed focuses on and the spread between the SOFR rate and the overnight rate on reserves and how it's influencing liquidity. But we went into the duration effect and the volatility effects, some of the malinvestment that was a consequence of this in housing and private equity getting attracted into housing. So again, that's good stuff. If you're interested in this, you should be a paid subscriber. And then we talked about the cockroaches, the Jamie Dimon, this almost throwaway comment. The bottom line here is that the household sector debt's still falling. It's at levels nowhere near levels that created the instability that was in play in 2008. Non-financial corporate sector debt is low. That's not an issue. Financial sector debt is low. Loan to deposit ratios in the banking system are low. There's no systemic credit risk here. We put some numbers on it. Unlike a lot of the people that just went on TV and talked about it, we gave you some real hard data about why this is not an issue. The issue is at the government level, but even those measures right now are very contained. Things like swap spreads, 30-year real rates, and term premium are all going down because that government spending growth rate is slowing. So we wrap the note up with our thoughts about, again, the markets here. The Fed easing, or the Fed ending QT, some people are going to interpret this as a positive macroeconomic step or positive monetary policy step. Ultimately, though, the Fed's going to have to decide what to do with the duration of their portfolio, and all roads lead to more bill purchases and less coupon purchases, which actually put upward pressure on rates over time. Again, that's why we're cyclical bulls, but secular bears in the Treasury market. We like financials here. We would buy them on the weakness that occurred late last week. We had a 2% bounce in the KRE regional bank ETF today, but we think there's a lot more to go there. We're a little bit worried about net revisions in the tech sector running on a momentum. We do not think we're at the end of the tech story here, but we may get a slowing of rate of change of earnings growth, and that could be a little bit of an issue in the numbers that come out, not this week, but the next. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.